Hello viewers, welcome to my channel. I am Hasham Ali Khan. So far I have completed 16 main problems on depreciation. Apart from that, 4 videos I have uploaded on MCQs and short questions. And the very first video on depreciation, meaning, causes, methods, all these things I have explained. So if you have not watched the earlier videos, it will be difficult to understand this problem. So before watching this video, I suggest you to watch all the earlier videos and then come to this. Then only you can get the complete command on the topic of depreciation. Now in this video, I am going to explain you about the problem number 17. So before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. Take a screenshot of the points of the complete solution of the problem number 17. Then I'll explain everything in detail. Now, see the 17th one. Virginia depreciates motor vehicles at the rate of 25% per annum using reducing balance method. Understand the problem carefully. What are the contents? So, Virginia Solted and she depreciates her motor vehicle at 25% on reducing balance method. She provides full year depreciation in the year of purchase and none in the year of sale. That means we should not calculate depreciation month-wise. We have to see if the machine is purchased during the year, full depreciation will be provided. If the machine is sold during the year, no depreciation will be provided. That is the rule given in the problem. Her accounting year ends on 31st December. That means year beginning from 1st January and ends on 31st December. She purchased a motor vehicle cost $10,000 on 1st April 2013 and sold it on 28th May 2015 for $7,210 cash. See carefully. Virginia purchased a motor vehicle for $10,000 when she has purchased on 1st April 2013. And she sold away this motor vehicle on 28th May 2015. That means she has purchased in 13, she has used in 13, 14, and in 15 it was sold away. So how many years she has used? 2 years. 2013 and 2014. So we have to provide the depreciation for 2013 and 2014. And 2015 we are not providing depreciation because during 2015 it is sold away. On the same date, she bought a new motor vehicle for $17,000. That means during 2015, another motor vehicle was bought for $17,000, paying by check, required. Now, one by one question we have to attempt, A, B, C, D, E, F. So 6 questions are asked. So one by one we will try to attempt. First, calculate the depreciation which had been provided on the motor vehicle at the date of disposal. That means from the date of purchase to the date of sale, how much is the total depreciation provided on the motor vehicle? When it is purchased? 2013. So we have to provide depreciation for 2013, first year. Second year, 2014, depreciation for 2014. 2015, it was sold away, no depreciation. So 2 years depreciation, first year and second year. So we are required to calculate depreciation for the 2 years. So calculation of depreciation, year 1. This is 2013. So what is the cost of the motor vehicle? 10,000. What is the rate of depreciation? 25%. So 25 by 100. So 10,000 into 25 by 100. 2,500 is the depreciation provided in the first year, 2013. Second year, 2014. Now we are following reducing balance method. According to this reducing balance method, deduct the depreciation. What is the cost of the motor vehicle? 10,000. How much depreciation first year? 2,500. So 10,000 minus 2,500, written down value is 7,500. 10,000 minus 2,500, 7,500 into 25 by 100, it will come to 1875. 1875. This 1875 is the depreciation for the second year, 2014. So total depreciation for the 2 year, 2,500 plus 1875, 4,375 is the total depreciation provided on the motor vehicle for 2 years, 2013, 2014. First question completed. Now second question, prepare motor vehicle account, provision for depreciation account and motor vehicle disposal account, because the motor vehicle is sold. That's why we have to prepare motor vehicle disposal account. The 3 account it is asking you to make. The first account is motor vehicle account. Second account is motor vehicle provision for depreciation on motor vehicle account. Third one, motor vehicle disposal account. These 3 accounts we require. Now carefully you watch and listen my lecture. Have some patience. Now see here. When machine was purchased, motor vehicle was purchased, the entry was motor vehicle account debit and bank account credit. But this entry will be passed at the time of purchase in 2013. We are not preparing the account for 2013 or 2014. We are preparing the account for the current year 2015. So 1st January 2015, balance brought down is 10,000. 10,000 is the cost of the motor vehicle. So balance brought down 10,000 on January 1st, 2015. This is the opening balance at the beginning of the year. So we have taken opening balance 10,000. Now, during the year, first of all, before making all these entries, first you make the account. One account you make motor vehicle account, complete format you draw it. Second, you make the format for provision for depreciation on motor vehicle, complete format. And third, motor vehicle disposal account, complete format. 3 formats you have prepared already, right? Now we'll start writing the entries. Brought down balance. The balance brought down 10,000. First, we have taken. Now, during the year, one motor vehicle was sold on 28th May. And another motor vehicle was purchased for $17,000 on 28th May 2015. So here May 28th. It was purchased by check. So entry will be motor vehicle account debit, bank account credit. So here bank 17,000. So 2 motor vehicle. That means this is the brought down balance and this is the new vehicle. But the old vehicle was sold. The old motor vehicle was sold away on 28th May. So whenever a vehicle is sold, you should pass 4 entries. Here I have written all the 4 entries when the vehicle is sold. First of all, we'll make a brought down balance. How much is the total depreciation provided on motor vehicle? 4,375. This is the total depreciation provided on motor vehicle for 2 years. So in provision for depreciation on motor vehicle, balance brought down on the credit side, January 1st, 2015, balance brought down 4,375. This is the total depreciation brought down balance, right? Now, whenever an asset is sold, 4 entries will be passed. The first entry will be motor vehicle disposal account debit and motor vehicle account credit. What is the cost of the motor vehicle? 10,000. The first motor vehicle which he has purchased in 2013, the cost was 10,000. So what is the entry? Motor vehicle disposal. A new account is opened whenever an asset is sold. That is disposal account. So motor vehicle disposal account debit, motor vehicle account credit. Now carefully you see here. This is the motor vehicle disposal account. 2015 May 28, right? Motor vehicle account. So how much is the amount? 10,000. The motor vehicle disposal account is debited and motor vehicle account should be credited. So motor vehicle account is created 2015 May 28. Motor asset disposal account or motor vehicle disposal account 10,000. This first entry posted. Motor vehicle disposal account debit and motor vehicle account credit. So this disposal account is debited and motor vehicle account is credited. First entry completed. Second entry, provision for depreciation. The total depreciation provided on that motor vehicle should be transferred to asset disposal account or motor vehicle disposal account. The entry will be provision for depreciation to motor vehicle disposal account. Provision for depreciation account debit, motor vehicle disposal account credit. So which account should be debited here? Provision. Provision should be debited. So here debit side, asset disposal account 4375. And asset disposal account should be credited. So credit side you can see provision for depreciation account 4375. So provision account is debited and asset disposal account is credited. Two entries are over. Third entry. The new motor vehicle is purchased for 17,000. A new asset is purchased. Oh, sorry, not new asset, but the old asset was sold away. The old asset was sold away. Motor vehicle was sold for how much? 7,210. $7,210. The motor vehicle was sold. The entry will be bank account debit, motor vehicle disposal account credit. So bank account debit, motor vehicle disposal account credit 7,210. We don't have the bank account, but we have motor vehicle disposal account we have. So credit side, motor vehicle disposal account, credit side, bank 7,210. So three entries we have completed. Now last entry, profit or loss. Now we have to check whether there is profit or loss. In simple terms, you see here motor vehicle disposal account. If credit side is more, you will get the balancing figure on debit side. That's a profit. Sometimes if debit side is more, you will get the balancing figure on credit side. That is a loss. In our problem, credit side is more. 4,375 plus 7,210. 11,585 is the total on the credit side. Whereas debit side we have only 10,000. So 11,585 minus 10,1585. This is the balancing figure. This is the profit on sale. The profit on sale should be transferred to income statement. So here we have written income statement 1585. And the details I have written here. Profit or loss. Book value of vehicle. Book value of vehicle sold. The vehicle was purchased for $10,000. Right? And the total depreciation provided on that vehicle is 4375. So 10,000 minus 4375, 5625 is the book value. And this 5625 book value of motor vehicle was sold away for 7,210. Sale proceed 7,210. Actually the value is 5625, but it is sold for 7210. So there is a profit. How much is the profit? 7210 minus 5625, you get 1585. So 1585 is the profit. The entry will be motor vehicle disposal account debit, income statement credit. So motor vehicle disposal account should be debited. So debit side you can see income statement 1585. Over. This account is over. Now we have to take the balancing figure here. 10,000 plus 17,000. Total is 27,000. Take 27,000 same. 27,000 minus 10,000. How much is the balancing figure? 17,000. Now this 17,000 is the balance carried down. Now take it to the next year, 2016. Our year 2015 is over. Now 2016 January 1st to balance brought down 17,000. This account is closed, completed. Now we'll come to the provision for depreciation account. In provision for depreciation account, we have to provide the depreciation for the new motor vehicle purchased. During the current year 2015, another motor vehicle was purchased for 17,000 and full year's depreciation should be provided on any asset purchased during the year. So during the year 17,000. 25% of 17,000, that comes to 4250. 25% of 17,000. The entry for this is income statement account debit, provision for depreciation account credit. The provision for depreciation account should be credited. Income statement 4250. This is the depreciation on the new motor vehicle purchased. Now take the total. 4375 plus 4250, you will get 8625. Same 8625, you take it on the debit side. Now 8625 minus 4375, the balancing figure is 4250. This is the balance carried down on the last day. Now next year 2016 January 1st balance brought down 4250. That's all. So we have completed provision for depreciation. Here automatically the asset disposal account is getting closed. See the debit side, 10,000 plus 1,585, 11,585. 4375 plus 7210, 11,585. Tally it, complete it. So this asset disposal account will always get closed, whereas there will be some balance remaining in provision account and also asset account. Motor vehicle account, we are having a balance brought down 17,000, and provision account we are having by balance brought down 4250. That's it. So B bit we have completed. Now I am coming to the C bit. Name the financial statement in which the provision for depreciation appears. State in which section it appears. It is asking you where the provision for depreciation will be shown in which financial statement. The two financial statements are there: income statement and statement of financial position. So these two statements, the provision for depreciation will be shown in statement of financial position. So here I have written C point. It will be shown in statement of financial position. So under statement of financial position, in which section it will be shown? The provision for depreciation will be shown under non-current assets. So in statement of financial position we have assets. In assets we have non-current assets and current assets. But the provision for depreciation will be shown under non-current assets. That's all. Now D. The D point, it is asking you, state how providing depreciation is an application of the accounting principle accrual or matching. How this depreciation provision is the application of matching principle or accrual principle. According to matching or accrual principle, all the cost incurred in order to earn the revenue should be taken. In order to earn the revenue, a number of costs are incurred. So we have to match the revenue with the cost. So here, when a non-current asset is purchased, the life of the non-current asset, the cost of the non-current asset will be spread over the life of the non-current asset. Example, if we purchase a machine for $10,000, this $10,000 cost of the machine will be spread over its life. Suppose the life of the machine is 10 years. So $10,000 divided by 10. That means every year 1,000 value will be consumed. 1,000 value of the non-current asset will decrease. So we have to take that $1,000 against revenue. We will match. Because for earning the revenue, we are consuming the non-current asset. That is the matching principle, accrual. The cost of the non-current asset and the revenue arising from its use are matched in an accounting period. So in an accounting period, we are matching. What we are matching? Revenue earned and cost incurred. The cost of non-current asset used will be matched with the revenue earned during the accounting period. The cost of the non-current asset is spread over its useful life. For example, the non-current asset is machine. The cost of the machine will be spread over the life of the machine. And every year a part of the cost is absorbed and matched against the revenue. That's why matching principle will be applied in case of depreciation. Next, E point. Name one other accounting principle which is applied when depreciation is provided. See here, when depreciation is provided, two accounting principles are applied. Accounting concepts are applied. The first accounting principle applied is matching principle or accrual principle. According to this principle, whatever revenue earned should be matched with the cost. So the cost of non-current asset should be matched with the revenue matching principle. One more accounting principle is applied in depreciation, that is prudence. According to prudence concept, the profit should not be overstated. That means whatever cost incurred in earning the revenue should be taken into account. So here we are incurring some cash cost, some non-cash cost. The cash cost are the salaries, wages, rent, etc. The non-cash cost is depreciation. When we purchase an asset, its value will get decreased. We have to provide depreciation. The decrease in the value is called depreciation. We have to provide depreciation, then only our profit will not be overstated. Otherwise, if we do not calculate depreciation, the profit will be overstated. That is against the prudence concept. Prudence concept says the profit should not be overstated. So two accounting principles are applied in depreciation. One accounting principle is matching principle or accrual principle. And the second principle applied in depreciation is prudence. Last one. State the type of asset for which revaluation method is suitable. There are many methods of depreciation. Straight line method, reducing balance method, then revaluation method, etc. Now, which type of asset revaluation method is most suitable? Remember the point. If the value of the asset is small, if the value of the non-current asset is small value, then it is better to apply revaluation method. In simple word, small valued items. For small valued items, it is better to provide depreciation according to revaluation method. That point you want to remember. Small valued items like loose tools or hand tools. So here, small items of equipment, example, loose tools. For loose tools, it is better to apply revaluation method of depreciation. So in this video, I have explained you problem number 17. In which, first of all, A bit we have calculated the depreciation provided for 2 years. B bit we have prepared the accounts. The accounts are motor vehicle account, provision for depreciation account, and motor vehicle disposal account. So watch the video 2-3 times. Then only you can be able to get the complete command. Because these are the lengthy problems, long problems, in the first attempt itself you may not be able to understand. So if you want to have a complete command on this topic, have some patience. Watch with full concentration. Definitely you can be able to understand. Inshallah, we will continue the next problem in the next video.